We felt scattered. I thought, why do we have two different financial advisors? One's doing one thing, one's doing another thing.
We felt sometimes like we were being guided in directions to spend extra money on things that probably weren't always necessary for us.
I would not know for sure if I should put my money in here or put it in there. Should I buy this real estate?
Like, I don't know what to do with this money, and I don't want to just blow it and spend it.
We were concerned about our financial health and just wanted a better financial picture.
And so when Earned came onto our radar and we sat down with our financial advisor, it just felt different.
I think a physician specifically should look at Earned because the focus is on our field. They know what a physician goes through at different phases of our career. To have that knowledge in order to guide us, I think is just such an advantage.
Earned isn't just about giving us financial advice. They're about doing the things that are needed to be done in order for you to fulfill your financial plan that they have created with you. And that really was very meaningful to me.
Earned is kind of like the conductor of an orchestra. You know, you pull in the trombones, you pull in the trumpets, you pull in the percussion. But Earned is the one that's holding the baton. I feel trust that they're taking care of my entire financial picture, not just one little part of it.
As a physician, I know that what I do for people is really powerful and impactful, and it's important for me to know that the level of expertise that I'm working with for my financial health is there, and I have that trust for them.
It's definitely valuable because I don't have to go looking a million different places. Like, I don't have a lawyer over here, and I don't have, the insurance thing over here. Everything's under one roof.
Earned brings clarity to my financial life.
With Earned, I feel really well taken care of.
I feel my financial health is secure.
I feel supported.
Earned is security.
I would highly recommend any doctor to look at Earned.
I love what I do, and it's really important for me that my patients have the utmost trust that I'm taking the best care of them. I have that same amount of trust with my financial advisors at Earned.
Hi, everyone. Welcome. Thanks for joining us today for Beyond the W-2, how physicians can maximize retirement contributions across income types, brought to you by Earned and Physician on Fire. I'm Amber, Marketing Manager at Earned. I will be your moderator for this webinar. Earned is a longtime partner of Physician on Fire and the first fully comprehensive tax and wealth firm built specifically for doctors, their families, and their practices. We bring tax planning, investing, retirement strategies, practice level advice, and now insurance and legal coordination, all under one roof, so your whole financial life works together. Before we get started, a few quick housekeeping notes. The chat icon is at the bottom right of your screen. Say hello, grab my attention if you need technology help. The questions icon is also at the bottom right of your screen. Please put all questions in that box, and our speaker will answer as many as possible during the Q&A at the end of the session. So today, we are excited to have Jorge and Nick with us. Jorge, as many of you know, leads the Physician on Fire community and has long been trusted voice for physicians pursuing financial independence and long-term clarity. Our speaker today is Nick Gizzarelli. He's a senior advisor and retirement plan specialist at Earned with over 15 years of experience in the retirement industry. He's a member of the American Retirement Association, holds multiple specialized designations, including credentials in advanced pension plan design. Nick is a key leader in building Earned's retirement business, where he specializes in helping physicians move beyond the standard W-2 mindset to unlock advanced savings structures. He's here to show you how to take a precision engineered approach to your wealth turning even small amounts of 1099 income into a powerful engine for retirement growth. With that, I will turn it over to Jorge to say a few words before we bring on Nick. Jorge?
Hey everyone, how are you? Jorge Sanchez here from Physician on Fire in chilly Florida, of all places. I woke up, it was 41 degrees here. Tried to walk my dog out, he ran right back inside. So welcome wherever you guys are. I'm excited about this webinar because physicians, we lead such complicated lives. I am actually a former W-2 and a 1099. And there was a part of my life where I was a W-2 only, then a 1099, and I was a combined, and I went back to 1099. So very easy to get lost in the complexity of those two statuses. So that's why I wanted to get the help of Nick to see if we could just navigate this complicated landscape and figure it out and not lose money, which is the important thing. So hey Nick, how are you?
Hey Jorge, hey Amber, thanks for having me. Really appreciate you guys having me this month. This is a topic that I think can go a lot of directions, and so excited to share some of the highlights and some key strategies here. And of course, hoping that there'll be plenty of engagement and questions here that can push this conversation in one way versus another. Just a couple quick housekeeping items from myself as well. We did have the power go out in our main office this morning. So if I disappear for a second, I have backup internet. I will be right back, I promise. I'm going to spend about 25, 30 minutes going over some key topics. Please submit your questions as we go. I have an eye on them. Amber has an eye on them as well, and we'll address those most likely at the end. But if there is an opportunity to maybe elaborate on the fly, I'll try and do that as well. So what we have on screen here is our agenda for today. And starting off with the W-2 mindset, and it's not necessarily a problem with the W-2 mindset, but you may be leaving opportunities on the table. And we're going to talk about beyond the W-2, different income types, and how that could lead to unlocking advanced retirement accounts or other saving strategies that could help you significantly achieve your retirement goals. And of course, we'll end with some key takeaways and some Q&A. So let's start with the problem with the W-2 mindset. So many physicians will assume that they have one option for retirement savings. And that's kind of what we're referring to here is their corporate retirement plan. If you're a W-2 employee, chances are you have access to a 403B or a 401k, and that may be about it. Maybe there's a match, maybe there's an employer component where they're funding a little bit towards it, but it does not give you a lot of flexibility with your retirement savings. And being a physician, oftentimes your largest source of investable assets starts with your retirement account. So it's very important to be thoughtful and mindful of what you're doing with this account. If you're fortunate enough to have the opportunity to earn 1099 income, whether it's moonlighting, per diem, locums, consulting, private practice, whatever it may be, this unlocks many different avenues that you can explore. Not all of them are created equal, so we're going to talk a little bit about some of these different paths and what may or may not be appropriate for each of you depending on your career choices. All right, so what we'll walk away with today, unlocking the different hidden, I put in quotes, hidden accounts, or the different vehicles out there that you can use as an investor and as a saver. How can you shelter at least $72,000? That's the kind of the minimum that many of these retirement plans offer, while avoiding costly mistakes, both from a hard dollar standpoint and a tax and savings opportunity. And of course, optimizing your plan or plans, because some of you may have access to more than one retirement plan. So let's start with this here. So this pie chart for 2026, this is kind of the high level overview of the various options that are available to an individual investor or a business owner or an independent contractor. Starting at the top with the IRAs, traditional Roth IRAs, these are available to any individual that's earning income somewhere. This isn't tied to a business. This is you as a personal saver putting money away into an individual retirement account. Once you become self-employed or employed in a practice, that's what opens up the 4 larger pieces of the pie. Now, I mentioned in the beginning with the problem with the W-2 mindset. The problem with that is you as an employee of a practice don't get to pick which of these 4 that you want to participate in, whether it's a simple IRA, what's called a SEP IRA, a 401k, or a cash balance. You're kind of at the will of the practice for them to say, this is what we are offering you. In most cases, you're going to see that third pie at the bottom where it's 401k. So it's either going to be a 401k or a 403b, where you as an employee can put away $24,500, maybe a little bit more if you're age 50 or better. And then the company, the business, can decide to give you an employer piece anywhere from 0 to $47,500. And if this is your sole source of income and this is your sole retirement savings vehicle, that means you are limited to this slice of the pie. And very likely you're not fully filling that bucket, right? You're putting away your piece, but it's unlikely that the company is giving you the full $47,500. More likely they're maybe giving you $10,000, $12,000, $5,000, somewhere in the lower to mid range, depending on how that practice is structured. Once you introduce independent contracting 1099 income, you become both the employee and the employer. So the decision becomes available, which of these do I want to open? And almost more importantly, not which of these do I want, because more is probably better if it's purely a want question, but which of these makes the most sense based on my income, based on my career trajectory, things like that, based on my structure. So let's dig in a little bit to this idea of those 2 types of income. So W-2 income, we refer to this, and W-2 income can mean a couple different things, right? Because you might be in private practice with an S Corp. Therefore, you are taking a W-2. But what I'm referring to most commonly here is you're an employee of a hospital, health system, group practice, multi-clinician practice, and you're receiving a paycheck as an employee. You're not necessarily involved in the decision-making or the leadership of the medical group itself. Okay, so you're an employee receiving a paycheck in a W-2. 1099 income is pretty much everything else, right? 1099 income is you're an independent contractor contracting with a medical group, hospital, or you're doing consulting, moonlighting, or other side income that is generating almost like ownership, like income for being a private practice owner. Whether or not you're incorporated doesn't quite really matter, right? These 2 buckets are generally seen as independent, separate sources of income for retirement saving purposes. And so what that means is this is giving you 2 times the opportunity to come up with a sophisticated saving strategy, because you are given potentially 2 buckets to fill instead of 1 when it comes to retirement savings.
One comment, Nick. So for a lot of physicians, and I've made this mistake in the past, the 1099 is very subtle. So if you're a medical director, that's 1099. If you do like medical expert witness work or consulting, that's 1099 work. So sometimes a lot of physicians have 1099 work, they're not aware of it and don't report it, and then they get into trouble. So just make sure that we're keeping an eye on that ball when we work.
Yep. Absolutely. And think of it this way. If you make $1, the IRS wants to know about it. If you don't see it on your W-2, very good chance it's on a 1099. And just Jorge, that was a great tee up here. Common sources of 1099 income. Locums, per diem, moonlighting, consulting, expert witness. Jorge just mentioned that. Private practice as well. So it gets a little tricky in the private practice space, because if you're in private practice, but you're doing work for other businesses, they may 1099 your practice, right? So there's a lot, it gets a little complicated in the private practice side, but all of these are potential sources of 1099 income.
One trap that for the 1099s who do locums, we work out of state. So a lot of locums, you fly out of state, you go to South Dakota, whatever, Juan Pepe, and you end up working. So what a lot of people do is they flow that income, that locums income, to their own personal LLC. And you got to be careful. This happened to me. I'm trying to shut down my phone. I was living in Arizona. I was a 1099 in Arizona. I did locums work in New Mexico. Fine. I was getting the 1099s, and Arizona is a state, Florida, it's a state tax entity. I moved to Florida because I wanted to save on the state taxes. So I moved to Florida, lost track of what I was doing, and then when I worked here in Florida, where I live now, I didn't change my 1099. I didn't attribute the 1099 to a new entity or to me. I made it to the old entity, which was in Arizona. So what's happening is I was working in Florida, but I was getting paid through my entity in Arizona, and guess what? I was getting taxed for a whole year as an Arizona resident, even though I lived in Florida. But because I was working, it was going through the entity, and that's a big screw up of mine. That was over $100,000 mistake. So my point to you folks that have these entities, if you move, make sure you close out that entity, make a new entity if you're going to do that, and make sure that your income is attributed to, when you fill your 1099, it matches the state that you're in for whatever reason.
Great. Yeah, and also brings up a great point that, when you receive a 1099, the way it's reported on your taxes is going to vary based on your entity, right? Jorge was talking about entities. You can be incorporated, or you can be like sole proprietor, and that will translate to different tax reporting. So it's generally recommended, if you're receiving 1099 income, at least have a CPA that you work with to help you with that, because things like Jorge's comment there can translate to tens of thousands of dollars in unnecessary tax. So let's take this. So we have W-2 income, we have 1099 income. I see a question coming in. This may answer that. If not, I'll elaborate at the end. But this is going to kind of say, now what can I do with this money? So a solo 401k is something that we see with 1099 income. And a solo 401k is a 401k plan, meaning you can put dollars in as an employee, and the company can put dollars in as the employer. However, you're wearing both hats if you're self-employed. You are both. Now, there's a couple key considerations here. A solo 401k is just a marketing term. There is no section in the IRS code for solo 401k. It just simply refers to a 401k plan in which you are the only beneficiary, the only plan participant in that plan. Your spouse actually can also be in the plan, and you two are treated as one. So that is still a solo 401k. Why is it important to be considered a solo? Well, you get to avoid certain IRS filing requirements. And as an owner, you're free to put as much as you want up to the IRS limit without triggering any funding or penalties or additional costs that a regular 401k may have. And so I'll talk about that here for a second. And I'll give an example. If you set up a solo 401k, the 401k limit this year is $24,500. That's the box at the bottom left here. If you're age 50 or older, that limit increases to either $32,500 or $35,750. They have like different tiers based on your age. So that's the first part of funding that goes into this plan. Then on top of that, you can put away up to 25% of your net earned income. So this, let's say you have $100,000 in net earned income is 1099. That's an additional $25,000 in pre-tax funding that you can put into this plan, getting you somewhere to the range of 50 to 60,000 total in this plan. Okay. The actual limit is 72,000. So you can, fill these buckets up until you hit 72,000 with a few exceptions there. But that's kind of how this works. So taking this back to someone who has both sources of income, If you are putting away money in a 401k through your corporate plan, or a 403b through your employer, and maybe that's only getting you up to 30,000 total benefit, this side gig, this 1099 income, can help you shelter and put away an additional 0 to 72,000. I'll talk about certain things of not double dipping in the 401k here in a second, but this is the high level reasoning why you would consider having two plans. All right. So how contribution limits stack up? That first bar there is a 403b or 401k. Think that you're putting away about 24,500. SEP IRA and solo 401k get you up to that $72,000 limit. So each of those buckets become available. And then for those of you that are really having really high levels of side income, 1099 income, there are things called defined benefit or cash balance plans. Generally, these make most sense if you're about age 50 or older. You can put away potentially $100,000 to $300,000 per year into this account. Of course, you have to earn the income to put it away, but this is available to anyone who has 1099 income. And let's stack these a little bit. Let's prioritize these. So if you are fortunate enough to have 1099 income or a private practice, there are 3 layers here. And the base layer is that 401k plan that you often have access to today with your company, with your corporate plan. There may be something called safe harbor or a match that comes with it. But together, the max that these are going to get you are going to be about $35,000 in total funding. The mid layer and the top layer are designed for those who want more than $35,000. So that's where we look at things like a cash balance plan or a defined benefit plan. That's where we look at things like in the top layer, profit sharing or mega backdoor Roth, which I'll talk about that in a second. We actually had a prior webinar all about Roth. And this is a very interesting strategy that could result in potentially hundreds of thousands of dollars of tax-free retirement dollars if you execute this correctly. So those are kind of the 3 tiers that we're looking at. And let's take a strategy. Let's go back to my example and let's look at real numbers. The first section here is a corporate 401k plan. So you're a W-2 employee for a medical group. Let's say you're making $200,000 to $300,000 is a W-2 there. Whether it's a 401k or a 403b, you will be eligible to put away that 24,500 401k or deferral yourself. Let's forget if you're age 50 or older. Let's just keep it simple. Maybe this plan offers what's called a safe harbor match, which is a very common plan design. If that's the case, the company is giving you a $10,000 retirement bonus, essentially, above and beyond your wages. Because the limit on the far left here is 72,000, that's 37,500 untapped, meaning that's how much you fell short of the maximum amount that you can put into a single retirement plan. So that's one of the limitations that we that I refer to throughout this call here. Now, let's say you're fortunate enough to have some $100,000 in 1099 net income. You have your own $72,000 bucket down there. Now, you see that the second blue number here is 0. We didn't put 24,500 to your 401k down here. The reason being is that 401k and 403bs, just like IRAs, your limit is across all of your retirement plans. You don't get to put 24,500 into every 401k. It is a per person limit. So you could split it among 2 employers or you can put it all in one. Okay. However, the profit sharing bucket is per company. So if you were employed at 5 different companies that offered profit share, in theory, you could get a benefit in all 5 of those retirement plans. So what we're looking down here is if you have $100,000 in net income, you can put 25% of that away, pre-tax, to a retirement account as profit sharing. And so that's where we're getting this 25,000. Now, I mentioned in a previous slide and a prior call the idea of mega backdoor Roth. Mega backdoor Roth is for those of you, just like this scenario here. I made $100,000. I can only put 25K into my solo profit share, but I want to save that extra 47,000 to get me up to the IRS limit in my solo plan. You can actually put it in as an after-tax contribution. IRS doesn't care that it's more than 25% of your earned income, and then you immediately convert it to Roth where it grows tax-free. So it's called mega backdoor Roth because it's the exact same strategy as what individuals do in IRAs to fund a backdoor Roth, but the limit is potentially 9 times as high because instead of going up to $8,000 or $7,500, depending on your limit, your age, you can put away, in theory, all 72,000 of your solo K as this backdoor Roth. So collectively, if you are doing both of these strategies, if you were putting away 72,000 in your own plan, and you were also getting the match in the 401k in your corporate plan, you're looking at over 100,000 in retirement savings, with almost half of it growing completely tax-free. Okay. I'll actually address this question right now because we're on the topic. This mega backdoor Roth generally is only available in 2 scenarios. 1, you're self-employed, so 1099 income or a private practice with no staff. Or 2, you are one of the few fortunate where your corporate plan has this turned on. And the reason why I say few and fortunate is this is very hard to offer in a multi-employee space because it's subject to very strict non-discrimination testing, which almost always fails. So 9 times out of 10, you need to be self-employed with 1099 or your own corporation to be able to offer this. All right. I feel like I've kind of harped on corporate plans quite a bit so far, but there's a couple additional things that I just want to highlight here at a high level. Why, if there's this $72,000 ceiling, why can't my traditional 401k or 403b get me there? And with that said, some do, especially if it's a multi-physician group or a specialty medical group, they can get you up to that limit. However, there's really strict non-discrimination tests that apply to any sort of benefit package. The IRS says, we want you to offer 401k to your staff, but we don't want you to offer a 401k plan that only benefits the highly paid workers and under benefits the, I guess, the lower paid workers. So because of this, you'll see most corporate plans kind of have a ceiling on how much they fund, like a match, or maybe they give you 7% profit share. You know, they have some kind of formula that they give you. This usually does not get you all the way up to a $72,000 benefit. And also, what we haven't talked about is the investment side of retirement savings. A 401k plan, given that there are potentially hundreds of employees all benefiting in this plan, are double scrutinized. They are watched by both the IRS and the Department of Labor and the SEC in a way to make sure that there's no mishandling of assets in this plan. Because me as an employee, if I'm receiving $50,000 of benefit through my own contributions in the company into this pot, and that's potentially going to fund my retirement, the government has a very vested interest to make sure that money actually achieves its goal. Because otherwise, public funding, you know, Social Security would be even more stressed than it already is to fill that gap. So because of that, investment options are often limited. You generally have a preset menu with limited, I guess, flexibility. Some do offer brokerage or other types of investment vehicles, but it's not required. It's not guaranteed that you will offer it. As a solo K owner, you are the employer and the employee. So whatever flexibility exists out in the world, it's something that we could look to offer in your retirement plan. And the last little bullet point here, kind of the question I answered a little bit early. Oftentimes you will not see that mega backdoor Roth feature or a cash balance or defined benefit plan, primarily for cost and testing purposes. All right. And so what do some of these numbers look like? Well, first off, average tax gap of $46,000. And this could be high or low depending on your individual situation, right? Because if you're deferring $30,000 worth of income each year to your corporate plan, you're missing out on 40 to a couple $100,000 in additional deferral dollars that you could be putting away, depending on your 1099 income and how much you're looking to save in your age, right? So if you think of this in terms of marginal tax brackets, if every additional dollar you earn this year is going to cost you 40 cents in federal and state taxes, that means for every additional dollar that you put into a retirement plan on a pre-tax basis, you're getting 40 cents back today. So that's kind of the very simplified math here. If I'm making $500,000, let's say I live in California, I'm paying 40 plus cents on the dollar to make my highest dollar. I can just shelter the top $100,000 in one or more retirement vehicles. I just got $40,000 to $45,000 back in my pocket today. So that is the true power of this option, of these many options that are available. Think of it over the course of 20 plus years. If you are unnecessarily paying 10, 20, up to $50,000 in extra taxes each year over the course of 20 years, not only is that potentially $1 million in tax that you're paying early, that's $1 million in assets that were not invested towards your retirement. And there is the argument of, well, I'm going to pay taxes at some point, right? And generally, that's, for the most part, that's true. You're getting a tax deduction today, so you will pay some tax later when you cash it out. But think of it this way. Are you going to be making $500,000 in the eyes of the IRS when you retire? Chances are you're not, because you're going to be grabbing retirement income from different sources that are maybe not all necessarily taxable. Two, if you're in a high state income tax or a high income tax state today, are you going to remain in that state in retirement, or are you going to move and retire elsewhere? There are a lot of things that, and three, are you actually going to spend all this money? Because some people like to leave an inheritance to their next generation. So getting a tax deduction today for you creates a larger inheritance bucket that could then be passed on to potentially lower income tax individuals on the next generation. Jorge, do you want to say something?
Yeah. So Nick, so if you're that, see that 73% of physicians are unaware they qualify for additional retirement accounts. If you're an employed physician, like what are the questions I would ask HR or look at the packet? You know, they always email you a big thick packet of paperwork at the beginning of your job. What are the questions I would ask to see if I qualify for additional retirement accounts?
Yeah, great question. And I'll try and share the questions in the order that I would ask them. First, is there a match on my retirement plan? Number one, I want to make sure I'm putting away enough 401k dollars or 403b dollars to get the full match, because that's just money left on the table. Two, are there any other employer contributions to this plan that I need to be made aware of? And do I need to do anything to qualify for those contributions? Okay. Three, do you offer mega backdoor Roth? Chances are it's probably no, but it's worth asking. Four, do you offer a cash balance plan, and how do I get access? Okay. And then finally, five, this isn't for HR, this is for your CPA. Do I have any 1099 or other sources of income? So we could talk about that whole other stream of decision-making that would apply.
Got it.
Great.
Important. By the way, 4/5 of U.S. physicians are employed as a W-2. Doesn't mean they're all W-2 only. A lot of them are W-2 plus 1099, like a hybrid model.
Yep. Yeah, we see that quite a bit. So we, as you may know, we work with a lot of physicians, and on that space, we see a lot of associate physicians who are receiving W-2. But even if they have $50,000 in 1099 income, even if they don't need the tax deduction because maybe their early career, doing a $50,000 backdoor Roth is huge, right? So there's a lot of opportunity there.
Got it.
All right. So let's look at a couple mistakes here. And I think this is going to be kind of more summary as we get to the kind of takeaways and Q&A section. Some of the most common mistakes we see: ignoring 1099 income. Like I said, you get a $20,000 1099. I mentioned there's a 25% profit sharing limit, not on Mega Roth. You can put away up to 100% of that is Mega Backdoor Roth. So if I have $20,000 of side gig income and I set up this Mega Roth solo 401k, I could put all 20 grand of that in as Roth. Granted, I don't get a tax savings today, but I just created a tax-free bucket that's going to grow for the rest of my life. Okay. 2, maximizing only, and I call it corporate plan just to be your W-2 plan, maximizing only that plan and thinking you're done saving for retirement. 24,500 seems like a good number. Maybe you get a match on top of that or a profit share, but relative to your entire earnings, if you're making $500,000 per year as a high earning clinician and you're only able to put away less than 5% of that to a retirement account, I don't think you're on track to hit your retirement savings needs. So it's important that you then ask those questions. What else can I be doing? If you're fortunate enough to have access to these other retirement accounts, great. It's an easy decision from there. If not, if you're a truly W-2 only, there are after-tax savings options available to you. But it's, that's a little bit outside the scope of the 40 minutes that I want to spend here today. Number 3, we didn't talk about this much, but overlooking entity structure. Jorge hinted at this when he was giving his example of different state incomes. When you get 1099 income, not only does it open up the opportunity to create your own retirement savings accounts, it gives you the opportunity to create entity structures. Should I form an LLC? Should I form an S Corp? Should I stay as a sole proprietor? These are questions that each translate to different tax outcomes. Quick example, if I'm a sole proprietor, I'm paying payroll tax, both sides of the payroll tax, on every dollar I make as a 1099, because I'm acting as the employer on that full bucket of money. If I form an S Corp, maybe I can pay myself a small W-2 to reduce my payroll tax and take a larger, what's called distribution from my S Corp, like a dividend kind of. I've earned the same income, but maybe I've saved a few $1,000s in payroll tax. So there's reasons that entity structure can create additional value, more from a tax and efficiency standpoint than from a retirement savings standpoint. And delaying action until year end. While some strategies can be started at the end of the year, you are grossly limiting, like significantly limiting the true savings opportunity if you're waiting until the end of the year or after the end of the year to say, ooh, I made a lot of money this year, what can I do, right? We want to be proactive, not reactive here. So even with a mid-year check-in to say, look, I'm on track to make X dollars, I would like the IRS to think I made less dollars. What are some pre-tax shelters that I could consider as an individual or as a business owner here?
One comment, Nick. I write a lot of the articles for POF, and man, in the last 3 years, there's been a lot of movement in tax law, a lot of changes. I just think that there's certain things like of 1, 2, 3, number 4, number 2, because of the tax law changes, because of the states, it's not a strategy you can do it yourself. I just think that I hear too many mistakes of just it's errors of commission and errors of omission that I keep seeing among my peers. We're too busy. We're running around too much. And it's just too much of a pain in the neck to go on the end of the year and just sit and look some website and figure out what the tax laws are that apply to you. You can chat GPT it, but it doesn't put a cohesive plan. No one knows all your structure, if you're only W-2, if you're 1099. No one knows that. So that's why I think very strongly some advisor needs to get involved and untangle the complicated financial dealings that we do to make sure that that we don't get into trouble. Like I'll give you an example. Like I know a friend of mine, he was moonlighting. He took all his moonlighting income into a taxable brokerage account for the last 5 years. And he asked me, like, how does he fix that retroactively? Because he wasn't happy with the ROI. That's not something I can handle. It's like, hey, dude, you're going to have to go to a tax advisor and figure all that out, because that's going to affect It's so that there's so many dependencies on that if you go and you break it, now it can affect other things. So that's kind of my point. Really be cautious. Do it yourself where you're comfortable and you feel that you understand it. But if you're looking up and Googling a lot of stuff and you're chat GPTing it, my advice is consider going to an advisor.
Great. Yeah, definitely appreciate that. You know, that's the world that we live in. It earned every day, as far as we see a lot of very, very smart individuals come to us, you know, but very smart in what they do. And while, yes, many of you on this call have the capacity to learn enough of this to get through it, one, do you have the time? And two, what's the cost of one mistake? And that's generally where we see it, as just one little slip here and there. You miss a $30,000 backdoor Roth that grows to $300,000. That's just a completely missed opportunity. So a lot at stake here. So I do recommend having someone who does this day to day walk you through a plan. All right. And so we're wrapping up here then to leave room for questions. So how do these strategies come together? First off, you need to identify your income. We don't know what we're working with until we know what you're working with. And then it's a question of, okay, now let's choose entity. And that's a little bit more of a CPA conversation, but luckily enough, like right next door to me is a CPA sitting there in the office next door, something that we're very familiar with and would be happy to chat with you about. Then it comes layer 3. Let's build the retirement program, considering both your W-2 wages, 1099 wages, private practice, whatever it may be. And let's not only maximize contributions, but optimize contributions. Not every dollar is made equal. Putting a dollar here versus there and deploying it a certain way into markets could have materially different outcomes come retirement.
And Nick, you know, this 4-step sequence matters. Like this is, if you guys wanted to take a screenshot, this is like the slide. Because a lot of my peers is that most physicians jump to step 4, which is maximizing contributions without doing steps 1 and 3 correctly. And that's how you end up over contributing, picking the wrong entity, or missing deductions your accountant should have caught.
Yeah, absolutely. So a great point. Like this slide really gives you 4 steps how to do it. Granted, you know, steps 2 and 3 do require some thought. But if you're going to sit down and say, okay, I want to execute a savings plan, this is the general flow of what you're going to do. And before I hand it back over to you, Jorge, here, just a quick example. $350,000 W-2 salaried physician and $80,000 moonlighting or 1099 income. The only difference between these two individuals, physician A only participates in the corporate 401k plan. Physician B sets up a solo 401k for their 1099 income. With that $80,000, depending on how you set up your plan, you could put away potentially $32,000 in profit share. You could put away $72,000 as mega backdoor Roth. Like there's a couple different options here. But even if you just think of it as the vanilla plan, I'm going to put away 25% of that income as a profit share. Over a 20-year career, you're talking about $1 million difference in retirement account value that you can then strategically draw on as you're hopefully living your best years, right, in retirement. So quick scenario there. I'm not going to go into too much detail with that. Key takeaways: 1099 income, if you have it, it's a blessing to really lean on, and it's your lever to be able to enhance and supercharge your retirement savings. Layering these strategies and not just thinking linearly, but thinking, hey, how can I shelter multiple sources of income is going to be vital for those of you on this call. And of course, always act early, plan ahead. If you come to us in January and say, hey, what can I do for last year? My hands are half tied at that point. There's not a lot that I can give you. All right, so disclosures on the screen. Jorge, I'll hand it back to you here for a second, and then Amber, back to you, I guess.
Great. So, Rick, thank you very much. A lot of learning, a lot of things. We have a lot of questions. So again, I really believe in one-stop shopping. That's what we work with Earned. We've been working with you guys for over 2 years. We actually worked together to develop the POF app. I call it your CFO in your pocket. You could do your finances, your investments, your portfolios, everything's in there. Plus all our top tier articles with golden nuggets are there for you to read and educate yourself on that. There's actually an article about 1099 versus W-2s on our website that you guys can check out. Again, check out the QR code, talk to these guys, let them untangle the spaghetti bowl of finances that we sometimes have. So I think that's good. Amber, you want to go ready for the questions?
Absolutely. Thank you so much, Jorge and Nick. That was excellent collaboration on making sure these physicians understand all the different types of income strategies and what they can do with their retirement. And so we have lots of questions today, and I'll start at the one that came in the earliest from Ricky. Ricky wants to know, I have 500K in W-2 income and I have 30K in 1099 income. I have a solo 401k that can do mega backdoor Roth. Can I max out my solo 401k to the 72K limit with money from my W-2, or am I limited to the amount of 1099 income I received and can only do max contribution to the solo 401k or 30K? All you, Nick.
So this is a question about income. What sources of income can be used to fund what retirement plan? And they are kind of one-to-one. Meaning, well, W-2 is one-to-one. Your W-2 income, unfortunately, can only be used to fund that W-2 corporate practice, multi-clinician group retirement plan. The $30,000 of 1099 income can be used to fund solo K, whether that's profit share or mega Roth. So in this case, just with these couple sentences on screen, I see you maxing your 401k with the W-2, hopefully getting a match or a profit share. And then with that $30,000, you can do about $7,500 in profit share, which is 25%. And the rest can be mega Roth up to $30,000. The rule is the lesser of 72,000 total contribution or 100% of your earned income. So since you only have 30,000 of 1099 income, you're limited to a $30,000 benefit in that solo K.
So Nick, would you think she needs to make more 1099 income to offset?
Oh, absolutely. I mean, if there's an opportunity to get that 1099 income to 80 to 100 grand, even after self-employment taxes, you'd probably be able to hit that $72,000 limit over there.
Yeah.
Good. So now she has another tidbit to think about. Next question. Omar would like to know, for something with a W-2 with a maximum self-employment tax paid through the employer, can you elaborate on whether I can contribute 20 to 25% to a solo 401k? The net earned income issue is there.
So this question demonstrates that this individual knows their stuff. Mm-hmm. So I say net earned income when I'm talking throughout this because there is a calculation that says if I make a $1 via 1099 income, I got to back out self-employment taxes to come up with a smaller number that I would have earned after taxes, employment taxes were paid, payroll taxes were paid. And what this is asking is there's a simplified calculation out there that says, hey, rather than doing this advanced calc, if I just reduce that 25% to 20%, and I know I'm not going to exceed the IRS limit. So to keep this like high level, to answer this question is, chances are you get to do the 25, not the 20, because when you do the real calc, you're actually not calculating additional self-employment taxes. It won't actually be 25, it'll be like 23 point something because Social Security and Medicare tax have different ceilings. But this is what I want you to take away from this is, if you're trying to get every penny from a solo 401k and you don't make hundreds of thousands in 1099 income, so there is a calculation required to determine how much you can fund, chat with your CPA to make sure you get this right.
Yeah. Absolutely. Omar, I hope that helps answer your question. And again, if you want to meet with Trevor and Nick to get you hooked up with a CPA that can help you with this, please let us know. Our next question, here we go. If someone makes 480 to 500K W-2 and maybe 10 to 15K in 1099, if you are getting 47K with W-2 related 403B, 401K, does that small 1099 income allow you to open the solo and put another 23K up to the 71K limit. Hopefully that makes sense. Lots of
Yeah.
K's in there.
Similar to the first question. So this is a scenario in which you make a lot of money. Most of your income is a W-2, but you're not getting the full $72,000 benefit. You have a very small 1099. How much of that can you use? And the short answer is 10 to 15,000, because that is how much money you made as 1099. Now, if you had 5 1099s that all came together into your single tax return, you can aggregate those, right? Because that's like self-employment income from multiple places. But we don't get to grab some of that W-2 wage and say, I'm using that to fund a solo K. Kind of to Jorge's point, the question is there an opportunity for you to increase that 1099 income? Because it's going to be potentially every dollar made can be put away into a retirement account.
Exactly. Hopefully that helped answer that question. And again, reach out to Nick. He can kind of dive into a consultation on that. All right. Mary Grace had a question. Do you get to 72 by putting 36K per spouse?
No. So $72,000 is the per person limit, not counting catch-up dollars if you're over age 50, that you can put into a qualified retirement plan, generally. And that's going to be 24,500 is your 401k. And then the remainder, 47,500 is going to be profit sharing dollars, match dollars, mega backdoor Roth. Any of those buckets together can get you up to 72. So that tells you two things. One, no, it's not 36K per spouse. Two, if you have a solo K and you have your spouse on your payroll, remember, that's still considered a solo K in the eyes of the IRS. You could double your contributions because you each, assuming there's enough income, you each could receive 72K in benefits.
Awesome. Yeah, that's a great strategy for that. She also had a backup question to this, and I believe this was based on slides 13 and 14. And if we want to put those back on the screen, we totally can to give you some context, Nick. But would this apply to any 1099 income other than medical businesses?
Yes. So this is 1099 income period. If it's a business, if you're generating what's called earned income, meaning it's not passive income, you're earning income from providing a service, from operating a business, you can absolutely use these strategies. The only time that you're going to see 1099 income not be eligible for this type of benefit or retirement plan is if it's passive income. Like if I invest in a limited partnership, a real estate partnership, and I'm just an investor receiving a 1099 as like dividend, that's not earned income. I didn't work for that income. I don't get to set up a retirement plan.
Very good. All right, our next question. So again, this was during the presentation. We might need a little bit more context for this, but the general question was, isn't the problem with too much pre-tax for inheritance would be the Secure Act 2.0 that forces distribution in 10 years? Maybe you can expand on that a bit.
It can. So the short answer is yes and no. The thinking is that if someone reached retirement age, actually older than retirement age, about age 73 or 75, they're subject to mandatory withdrawals from retirement accounts. And the reason being is the IRS wants you to spend your money so you can spend it. Two, they want their tax dollars. They don't want you to hoard it in a pre-tax vehicle for the rest of your life and then pass it on to the next generation, potentially at a reduced or tax-free rate. If you have millions of dollars in a traditional 401k, those withdrawals are going to be about 4% of that account every year through the rest of your life. If you pass away and you hand it off to your heirs, they may be required to withdraw the full amount within 10 years. Now, two things with that. One, it's may. If it's a spouse and you pass away at a certain age, your spouse can essentially make it theirs, and they can then use it as if it was theirs their whole life, and the 10-year rule doesn't apply. If it's someone other than a qualified beneficiary, like let's say you give it to your sibling, you give it to whoever, and it is subject to the 10-year rule, it's at their tax rate, not the deceased tax rate. And 3 out of 5 times, if not more, it ends up resulting in a tax savings because the tax was deferred at the peak earners, peak years, and is spent or paid at potentially a child's or someone else's tax rate where if you're giving them money, chances are you think they're going to really enjoy and benefit from it. So they probably have less money than you had.
Very good. Thank you for answering that.
Hey, Amber, one question. Someone asked, and it's actually funny because we've been this comment. So the app, the mobile app, when they do a search, they get this Plenty of Fish, which I guess is a dating app. What is it under the? Is this of Android and is it under Android or is it only Apple?
So the thing with the POF app is it is specially created for POF, and it is downloadable on the App Store with our link. So I will be sending out the link in our emails to everyone who registered for this webinar to make sure that they can access accordingly and get this very exclusive POF app. This is not for everyone on to utilize. It is specifically for POF. So we hope that also brings, a little bit more individualized planning for them. But yes, don't just naturally search up POF and get on that dating app right away. Mary Grace, I saw your question. I will happily send you that link so that you can access the app. One more question before we kind of end our time. To really make most of the W-2 income, let's just say less than 10,000 in 1099, both of us do 72K. Anything else you can see help lowering that taxes? Maybe from a retirement standpoint, we can even add on a CPA as well.
Yeah, so this is, obviously this is a common scenario because there's been a couple questions that are of this flavor. Most of my income is W-2. I have a little bit of 1099 income. Well, okay, that's 10 grand that you can put away as a mega Roth, not tax savings, but it grows tax free. So there's a little bit there that you can do above and beyond the corporate plan that's allowing you to do 72K or up to 72K. Where you're at this point, if this is your reality and the opportunity to increase your 1099 income is not there, or you don't think it's going to be substantial, the next two places you'd want to be looking at are, first off, am I doing just a regular backdoor Roth? Because each of us, my spouse and I, can put away $7,500. That's $15,000 per year. It's also getting put into a Roth above and beyond everything we've talked about today. And now I'm in the after-tax world. If I checked all those boxes, now I'm in the taxable brokerage account world. So if I still want to put away another $5 grand a month towards my savings, doing that in a tax effective way with things such as custom indexing, direct indexing, or other tax efficient vehicles, technically not a retirement account, but someone who just invests in a mutual fund versus someone who does a tax active approach in their taxable account are going to see a materially different outcome. We quote like 1.9% per year in what we call tax alpha or tax benefit. I'm not quoting that right now on screen because I don't have the disclosures with me, but I believe it's more than zero. We'll leave it at that.
Awesome thing. We have time for one more question. Benjamin posted a last minute question. I really want to get this answered for him. So little context before I put it on the screen. If you are currently a partner / shareholder in a small physician practice that is W-2 S Corp, that hits their 415 limit through the employer sponsored plan, here's the question related to that. Is there a way to designate part of the income, likely the distribution amount, as 1099 to keep your W-2 income to hit the 415 limit, or and also have 1099 income to open up other avenues?
Short answer is probably no, because what you're describing is a related employer. IRS is going to see what you're doing, and they're going to say, no, we're not going to let you get two buckets because you just created a separate structure with the same business in a way. It has to be separate income. My second piece to that, though, is if you're hitting your 415 limit, which means you're putting away 72,000 plus, you're hitting the IRS limit. Have you looked at a cash balance plan? Because that is exactly what that is for. I hit 72,000, but I want to hit 200. That's where cash balance comes into play. So if that is something that you haven't explored, you're probably going to have more success looking at that.
Perfect. Thank you, Nick, for
The
explaining.
IRS doesn't let you pick. It doesn't let you pick.
Yeah, that's kind of the bummer. Benjamin, I hope that answers your question a bit. And again, I would really connect with Nick on that. That is his specialty. And we can get you going on that cash balance plan. Jorge, we're at time, but I want to give you a chance to give some takeaways and kind of end our webinar here today.
No, great. Thank you, Nick. As always, I always learn from you. So 4 points, big points. So your employer plan is a starting point. It's not a finish line. So when you do a hospital-based employee deferrals, your potential is smaller. But when you stack it with a 1099 income, you can shelter more money. So that's number one. Number two, even small amounts in 1099 income can change everything because you have more choices in where you can attribute it to what vehicle you can use. So even a few moonlighting shifts, a consulting gig can definitely improve your contribution limits. The third one, which is a painful one that I learned, is entity structure matters more than most physicians realize. You got to make sure that you get good advice on how you want the 1099 flow, whether it's a sole proprietorship, LLC, or S corp, because it's actually going to affect your downstream contributions. And one of them, number 4, and the last one is waiting is the most expensive mistake. Don't wait. Your solo 401k plans must be established by December 31st, come for that tax year. And the more you delay, the more you screw up the year's contribution. And all of this is important because remember, 4 out of 5 physicians are W-2, 1 out of 4 is 1099, and there's a mix in between that pool. So we definitely live very complicated financial lives. Again, thank you very much for everyone being here today. Thank you, Earned. You guys are a one-stop shopping wonder. And then we'll see you guys again at the next webinar. Take care.
Thank you, everyone. Thanks, Nick. Thanks, Jorge. Everyone, see you next time.
Thanks all.